promised, here's our exclusive conversation with Keki, Mistry of HDFC and Amitabh Chaudhry of HDFC Life on that mega merger with Max Life and what it means. Remember, post-merger, we will see India's largest private sector insurance company being created.
I think it'll be a very formidable force because we'll have the strength of the HDFC Life team and the strength of the Max team. Both are good, strong entities. We'll have a very strong distribution platform. So let's see how things work. There's a lot of synergy in the merger, which Amitabh can explain in much greater detail. But there is a lot of synergy. So my sense is it will create a huge amount of value for shareholders of both HDFC Life as well as the Max shareholders who move into HDFC.
As far as cost efficiencies are concerned, how do you see this going forward as a merged company?
So there will be a lot of cost efficiencies that will certainly kick in. Offices, for example, rents, for example. I think Amitabh mentioned about reinsurance premiums, so we may get a better reinsurance deal, will be larger in size. So there will be a lot of cost synergies that will come in. So now over the next few days, there is an implementation committee which has been set up, and the implementation committee will sit and, work out and see what benefits we can get, where we can cut costs, where we can get more revenue growth, and so on and so forth.
So many congratulations on the finalization of this merger, and want to know about the overall valuation on this one, Mr. Chaudhry. Take us through the valuation and the market cap that you're expecting once it's a listed entity, HDFC Life.
So, as we stated in the press conference, the relative valuation of the two entities is 69% and 31% for HDFC Life and Max Life respectively. We never looked at the implied or imputed market capitalization of the merged entity when we were doing the merger. We were just looking at the relative valuation. We started on taking the March 31st, 2016 embedded value numbers of both the entities, and we worked off from there, and finally we arrived at a certain ratio. A certain EV multiple for them and certain EV multiple for us, which has led to 69%, 31%. Yes, as you asked me in the press conference, if you take the Max Financial Services price as it stands, let's say on Friday or today, and they own close to 70% of Max Life, and we're imputing a 31% value to that and 69% value to us, you can work out what is the imputed market cap of the combined entity, and it works to upwards of 65,000 crores. I'm not saying that is the right number or a wrong number. That the market will decide, I guess, tomorrow, and that is for the market to decide. I think we are very focused on ensuring to get to this point, and which has taken us 50 days to get there, a lot of hard work to get there from all the sides. And now we have to do a lot of hard work to satisfy.
But on that point on embedded value, what is the multiple you're giving? Because I also asked you the question in the press conference earlier. If you use the same multiple, the value, the attributable value for Max actually works out to 35%. Not 31%. Yes. You're saying 69, 31. Yes. So it's actually lower. So I'm just asking, what is the multiple that you've used?
So, to give you some examples, so if you apply a multiple of 2.6 to Max Life embedded value, and you apply a multiple of 3.17 to us, you will come to similar numbers. It's very important, and I think Mohit clarified it. It is very important why we did some our multiple increase and their multiple came down. The reason it was done was because we have a bank franchise. We are part of a group where a bank is very much a part of the entire group.
So HDFC Bank, you have captive HDFC Bank. Okay, so on that point, some of the past deals which have happened, right, in the case of Max or in the case of HDFC Life, it's been the opposite. I mean, Max's deals have happened at a bit of a premium, and if you look at HDFC compared to Max's deals, the multiples have been lower. Here, the deal is completely the opposite.
Well, you are assuming that what they are, the kind of deal they've done with Max Life pays much more to Axis Bank than compared to what we pay to HDFC Bank.
I'm talking about private market deals.
Oh, okay.
So I'm talking about KKR.
So let me finish why it got changed.
Go on.
So one was that obviously we looked at our brand, our franchise, our margins, which are better than theirs, our size and scale and everything. That was one. Secondly, they have a deal which lasts only up to 2021. And once that deal finishes, we might have to enter into another deal with Axis Bank, and we might have to pay a value for that, which was not the case.
Hopefully with HDFC, you have the captive,
it is No, it is not captive to the extent that we have been paying to HDFC Bank regularly, and it's part of the overall deal. I mean, there is no end date to it.
Sure.
Third was in the due diligence. When we went through the due diligence, there were certain things which we found where there was an adjustment of value which was required, which we adjusted.
Like what? What exactly?
So there are, for example, I don't want to go into details because I think they are confidential in nature, but there was some due diligence findings. Nothing to worry about. I don't want to create a...
when you say due diligence, it always raises
so
up.
there were, you know, the way they look at reserving, you know, providing reserves.
Okay.
The way they look at taxation.
Okay.
And so there were some elements which we found.
So basically, accounting in
accounting
nature,
issues. There were nothing which we found which alarmed us, or alarmed anyone for that nature. But it did require a change in valuation. Fourth was that a part of their embedded value, a big part of their embedded value is cash. Now we can't apply the same multiple to cash than real embedded value.
What about the private market deals? If you compare the deals which have happened on the part of Max and on the part of HDFC
So Max
Life.
has done a deal with KKR, and they have got a higher value than what they have done a deal with KKR. KKR has done a deal at a particular price.
But if you compare the deals HDFC has done and Max has done, how would you rate them?
So,
do you think the multiples
But the deals are very different. You know, when you look at Standard Life deal which was done recently, which is the last deal with HDFC Limited did with Standard Life, please understand that Standard Life had the right to take their shareholding up to 49%. They gave the options up for 14% of what they had as a right. And as part of that, HDFC gave them a small discount. Please also understand and realize that the max embedded value multiples till January, February were 2.5 times to 2.6 times. It is only the run-up which has generally happened in the Indian stock market, and especially maybe let's say the insurance tiger, which makes some of these multiples look higher. So it's a combination of all factors. It is not necessarily one thing which has driven it to this number, and that's why we are very, very cautious when we say, please don't hold us to this market cap or this market number, because that's what the market has to decide. We are no one to decide and tell the market this is our expected market valuation.
So 22,000 odd crore rupees is the valuation that you're pegging a Max Life insurance business at. I know you've given several details on why there's no reasoning to how market cap, but then it's at a substantial premium to the last deal that had happened in the same company, right? So I wanted to know the basis of valuing HDFC Life at over 45,000 crore rupees. I'm asking you also because you will be a combined entity close to about 70,000 crore rupees in terms of market cap, and your nearest competitor, whom you have just pipped from the top position in the private insurance space, is expecting a 50,000 crore rupees of market cap when they list on the exchanges.
So I don't want to get caught up in this market cap and the market value game, because it will be unfair to do that. But let me try to answer your question. I would like to repeat, the price run-up which has happened since, let's say, May 31st or from the beginning is about 50%. We have not done the valuation on this 50% rise in market cap of Max FS over the last 90 days or so. Our valuation has been based on March 31st multiples. Now the market believes, and actually puts an onus us to perform, market believes that this franchise which is coming together, or this franchise which will get created, will be extremely powerful, and they're willing to pay this price for this franchise. I mean, that's the only message I can get from the kind of value, the way the value of Max Financial Services has gone up. Now we have to make the merger happen and actually deliver the kind of value which the shareholders are expecting for us to sustain this particular price. And that's a tall ask, and we obviously are looking forward to it, but there's still some distance to cover in terms of getting the merger done and then delivering that value.